welcome to this episode of the Maryland Risk Management Education Podcast. My name is Paul Geringer. I am the host and the Extension Legal Specialist here in the Department of Ag and Resource Economics with the University of Maryland. And today we're going to kind of switch topics and talk about something else I work on here at the university. We're going to talk about some crop insurance issues. I think we're going to have couple of crop insurance episodes here over the next couple of scheduled times we drop these episodes. So I think now we'll have one. We'll skip crop insurance for the next episode and go back to some Syngenta settlement issues. And then we'll come back in a couple of weeks with another one on gleaning and crop insurance. So I'm going to have a couple here as we get prepared for people who are doing different things on the farm, just to remind you of what some of the rules are related to crop insurance. But with crop insurance, there is this idea that you have to now certify conservation compliance for the crop insurance program by the premium billing date. This had been set up originally to be done by a date. We'll talk about that here in a second and why you have to do this now. But now it is by the premium billing date. So let's go ahead and talk a little bit about that. As many of you who have purchased crop insurance may have known, since the passage of the 2014 Farm Bill, conservation compliance has been relinked with the conservation insurance subsidy. This relinking means that many producers who have traditionally not participated in Farm Bill programs, so if you're producing and not participating in price loss coverage or agricultural risk coverage, or PLC, or ARC as they're more commonly known, you may not have had to do conservation compliance in the past. If you hadn't gotten a direct payment or counter-cyclical payments under previous farm bills, you probably didn't have to do conservation compliance potentially. There may have been other programs you participated in that required it, but those are some of the bigger examples. The 2014 Farm Bill changed this. Under the 2014 Farm Bill, producers who skip the other farm safety net programs offered by USDA's Farm Service Agency, or FSA, but still take out crop insurance will still need to complete and file FSA's current highly erodible land conservation and wetland conservation certification, also known as Form 80-1026. Without an 80-1026 on file, farmers will be ineligible for many USDA programs now, including the premium support paid by the Federal Crop Insurance Corporation. This 80-1026 will need to be on file with FSA for a reinsurance year on or before the premium billing date for the producer's crop insurance policy to comply. Prior to this, it had been by a certain date. It had been the same date that FSA required it for all programs, but now it's becoming a little more flexible, so it needs to be on file by the premium billing date. So what does conservation compliance mean? Conservation compliance is concerned with producing an annual crop on highly erodible land and conversion and production on wetlands. These two aspects of conservation compliance have been required since the 1985 Farm Bill. In previous Farm Bills, conservation compliance was linked to participating in commodity programs such as the former direct and counter-cyclical payments. You could go back previous Farm Bills. There had been other programs this had been linked to as well. Conservation compliance had previously been a part of the crop insurance program, but was removed in the 1996 Farm Bill to encourage more producers to purchase crop insurance. In 2014, the Farm Bill relinked the two after fears that a push towards a more crop insurance-based farm safety net would lead to marginal lands being put into production without requiring compliance. Looking at the two aspects of conservation compliance, highly erodible land compliance provision, this is also referred to as sod buster. This requires a producer to have an approved conservation plan in order to produce a crop on highly erodible land or not produce a crop on land classified as highly erodible between 1980 and 85. A producer would also need an approved conservation plan to produce on highly erodible land in 1990, regardless of when the land was put into production. Sodbuster is, as we look at this, the easier of the two aspects to stay in compliance with, because producers just need to follow the approved conservation plan on highly erodible lands. The second aspect is the harder one to me. The second aspect is wetlands conservation compliance. This is often referred to as sodbuster, which requires a producer to refrain from producing a crop on converted wetlands. If the conversion happens after February 7th, 2014, if you're wondering where that date came from, it's the date the 2014 Farm Bill was enacted. When the producer will be ineligible to receive the premium subsidy in future crop years, but the producer could potentially remain eligible if it is determined that fewer than 5 acres were converted and the producer pays 150% of the cost to mitigate the wetlands conversion to a USDA fund used to restore wetlands. It's always fun to say some of this. So what happens if you're violating the Swamp Buster provision? Like I said, this is the one you're going to potentially violate the easiest. If you're found to violate the Swamp Buster provision, you will have 1 year to begin a mitigation plan to remedy the violation. This 1 year will begin after an administrative appeals takes place. So there'll be an administrative appeals process that could take a while. If the mitigation plan is not initiated within the 1 year period, then you will be ineligible for the premium subsidy for all following years, meaning you are still eligible to buy crop insurance, but you pay 100% of the premium. You no longer get the federal crop insurance subsidy to purchase it, premium subsidy to purchase it. It's all on you at that point. What happens if a crop does not currently have a crop insurance policy? If a commodity is not currently covered by the crop insurance program but becomes eligible in the future, then the 2014 Farm Bill's ineligibility will not only apply to wetlands conversion taking place after the policy becomes available. The new Farm Bill, I say the new Farm Bill, even though we're debating a Farm Bill, I should be clear, the 2014 Farm Bill appears to simplify many aspects of wetland conversion. Here, the producers found in violation will be given 2 years after the final determination, and appeals has run its course to implement a mitigation plan. If the producer does not implement the mitigation plan, within 2 years, the producer will be ineligible in future years for the subsidy. How do you show compliance with all of this? Like many former farm programs, you will need to file this 80-1026 each year to self-certify that you're in compliance with provisions. USDA's Risk Management Agency, or RMA, has changed that deadline. It used to be it had to be on file by June 1st with the county FSA office. Now it just needs to be on file by the billing date, the premium billing date for the producer's crop insurance policy. If you get it in by June 1 and that's before the premium billing date, that's fine. But it just needs to be on file by the premium billing date. Producers relying on crop insurance must now continue to keep considering conservation compliance. Producers will have to have a conservation plan in place and will not have to worry about sod provisions. The issue is always going to be Swamp Buster and making sure they stay in compliance and they don't convert a wetland. If you have any questions on this, please shoot me an email at lgoering@umd.edu, or you can tweet me at aglawpaul. All that info is at the bottom of this. Thank you for listening and enjoy the rest of your day.